The markets are a little bit sloppy right now, but it's against this backdrop that Instacart, the grocery delivery company, will be going public. They priced at the high end of the range, perhaps comforted by ARM Holdings and its well-received debut. So they're expected to, well, they priced at $30. The indication right now is $39 per share. So appetite looks very enticing. But even at this level, it is valued at, really just a fraction of what it was valued during the pandemic at $39 billion. But our next guest is not a buyer here. Eric Jackson, founder and president at EMJ Capital. Eric, thank you so much for being with us. And it's great to have you because I remember pressing you about, the NASDAQ must be getting too frothy. Mm-hmm. And you said, I'll call it frothy when Instacart goes public. Right. So here we are. Yeah. Instacart's going public.
Yeah, exactly. Well, it's an important mile marker because I really don't think I think ARM was a special case IPO. I wouldn't really call it a good barometer of the health of the tech market because it's 33 years old. Yeah. It only sold like 10%, a sliver of its shares. It's got the AI pixie dust, sprinkled all over it. So if you put that one aside, there really hasn't been a tech IPO that I can think of. There's been like restaurant IPOs and kind of other things for 2 years now. So the fact that we're back here, it means that, there's some belief that there's enough appetite out there to get this get this out the door.
So I'm going to ask what it means for the NASDAQ generally, but let's dive deep into Instacart because, you're getting it at definitely less than it was valued during the pandemic. It's still growing at a healthy clip. The multiple on sales is like around what you get for DoorDash, so it's not crazy. Right. But you're not jazzed about it.
I just think it's, are you jazzed about DoorDash at these levels? It's like, they're fine businesses. They're going to be around, for some time. But you're buying a 30% a year grower. Is that really that compelling? Margins are okay. I think they're trying to make a big deal out of the fact that there's a big advertising business potentially. So everything that went out the door in 2021 is down like 75%, in the similar way to what Instacart is. Yeah. So I think you just have to step back and say, even at that discount, we're not in 2021 anymore. Where it is now, what is it that's going to get you excited about this business? And I think it's just better to kind of let things settle down. Things will shake out probably. Sometimes, things can get off to a hot start like ARM did the other day, and then 2 days later it pulls back, enormously. So,
it's interesting to hear you kind of poo-poo 30% growth. The world economy is barely growing at 3%. Mm-hmm. Apple is its sales are falling. That seems like a very healthy number in this environment.
It is. It's not a software business, obviously. These are special case businesses, lower margin. They're trying to layer on advertising to get their margins up. I think it is a business that's going to be around. I used it last weekend, and one of the things that you notice is that if you buy, I bought some stuff from Shoppers Drug Mart, and I'm online and I'm looking like, is it dental floss that much these days at Shoppers Drug Mart? And what you find out is that Instacart just automatically jacks the price up. And I'm sure that's what makes...
For the convenience factor. Yeah. They're going to bring that floss to you.
Yeah, and I'm sure that makes them a good partner for the Shoppers of the world or whoever that they're working with. They know that they're going to be able to sell full price. You're not getting discounts. And then by the time you pay the delivery fee and you pay this fee and then that fee, and they try to upsell you on the priority delivery service as opposed to the regular delivery, you're going to pay more. And people will pay. I'm sure there are a number of people. It's just, I don't know. Is it going to change the world? Is it, is this going to be, a 2Xer or a 3Xer, from here in a year or 2 years? I doubt it. So for me, I just think this is a kind of name that I would rather see it shake out. Maybe it has some big pullback. Maybe 3 months from now, it's half the price of, it's whatever, 39 you say, maybe it's going for 20, and then maybe there you want to step in or something.
Okay, so as I said, we're still waiting for that initial trade. Indication is $39 per share, so we'll see how that goes when the stock actually launches. But what it means for the broad market, I think, is also interesting because you've been a big NASDAQ bull and thinking that, we're just in the early innings of the rally. Do you still feel that way?
we're sort of in a holding pattern right now in the NASDAQ. We had a good run in the kind of first part of the summer. August, there was a pullback, and then things have stabilized. But I don't think we've really gotten a clear direction of where we're going. Maybe when we get the Fed decision tomorrow, it'll set the table. I think we're sort of waiting to kind of see which way we're going to move. So I don't think this is, one IPO like this isn't going to tell the story of where we're heading. I mean, they simply could be like doing this because they're going to run out of cash and they need the money. And so I think what you want to see is evidence of like 2 or 3 or 4 IPOs happening over the next few months.
We're going to get another one. Klaviyo is another one, which is, I guess, really good at spam email.
Right. I'd like to see like 3 or 4. And then if that's the case, then you could say, yeah, well, there's basically enough risk appetite that's come back into the market where, it should help broaden the rally away from just the big stalwarts to some of the smaller and mid-sized tech companies, which has been kind of hit and miss so far this year.
We saw, and you're probably my only guest who's ever come on and said, you should buy some of these money-losing tech companies because they were doing really well. That was kind of a barometer of sentiment at the time. Are they still doing really well? I know you use sort of AI to help inform your investing decisions. Are they still screening as attractive, like a Real or something like that?
Yeah, I still own Real. I still own Carvana. Those are like, 2 poster children for what you're talking about this year.
High short.
And, but I would say it's really, it varies stock by stock. This has been a great year to be long and short. You could, some of these smaller cap profitless tech companies are still, flat on their backs and not doing anything. If you look at Cathie Wood's ARK Innovation Fund, for example, like it's been kind of stuck, stagnant for the last few months. And I think a lot of the smaller mid-cap names that she owns, things like Zoom or UPath or something, which I'm short right now, just haven't worked out. So you just have to kind of look stock specifically, look what's going on in the company. In the case of Carvana, like that thing, sold off 98% last year, so it was like on death's door. People didn't expect anything from it, and they've turned it around somewhat, at least to this point. So you just got to go case by case.
Well,